The silver market just confirmed something that hasn't happened in modern commodity history. 6 consecutive years of deficit. Not 1, not 2, 6. And most investors have no idea what's actually happening right now. Let me show you the data. On February 10th, 2026, the Silver Institute released their annual market outlook, and the numbers are striking. Global silver demand is expected to exceed supply by 67 million ounces this year. That might not sound massive, but here's the context. Annual mine production is around 820 million ounces. We're talking about an 8% supply shortfall. And this isn't new. This has been happening every single year since 2021. So today we're breaking down what's really driving this deficit, why it matters, and what the potential implications could be for the market going forward. But before we start, quick disclaimer. This video is for educational and informational purposes only. Nothing here is financial advice. I'm not telling you to buy or sell anything. Always do your own research and consult with a licensed financial advisor before making investment decisions. All right, let's get into it. First, what does a market deficit actually mean? It's simple. More silver is being consumed than is being produced. Think of it like a bank account. If you're spending more than you're earning, you're pulling from your savings. In silver's case, the savings are above-ground inventories, bullion sitting in vaults around the world, primarily in London, which is the physical hub for silver trading. Since 2021, the market has been pulling anywhere from 100 to 250 million ounces annually from these stockpiles. Now, silver does have substantial above-ground reserves, but here's the thing. You can't drain savings forever without consequences, and the physical market is already showing signs of stress. In late 2025, there was significant tightness in the London silver market. Metal was being moved from London to New York to hedge against potential U.S. tariffs under Section 232, the Critical Minerals Investigation. That movement created a liquidity crunch. Less metal available in London meant tighter physical conditions. And when physical markets get tight, prices can move fast. We saw that in January 2026 when silver briefly hit an all-time high of $121 per ounce before pulling back. As of February 20th, silver is trading around $79 per ounce, still up 162% year over year, but down about 35% from that January peak. So the deficit isn't just a number on a spreadsheet. It's creating real-world supply dynamics that are influencing price behavior. All right, so why is the market in deficit? Let's break it down into 2 parts. Supply and demand, starting with the supply side, and why production isn't growing. You'd think that with silver prices more than doubling over the past year, miners would be ramping up production, right? Not exactly. Silver mine production is only expected to grow by 1% in 2026 to about 820 million ounces. Why so little growth? Because roughly 70% of silver is mined as a byproduct of other metals. It comes from copper mines, lead and zinc mines, gold mines. Only about 30% comes from primary silver operations, mines specifically built to extract silver. What this means is that silver supply is largely inelastic to silver prices. A copper miner isn't going to increase production just because silver prices are high. They're mining for copper. Silver is just bonus revenue. So even with elevated prices, we're not seeing a massive supply response from the mining sector. What is increasing is recycling, also called scrap supply. With prices so high, people are cashing in silverware, old jewelry, and industrial scrap. Recycling volumes are projected to rise 7% in 2026, surpassing 200 million ounces for the first time since 2012. But even with that increase, total supply is only expected to hit 1.05 billion ounces. A decade high, yes, but not enough to meet demand. Now let's talk demand. Total global silver demand in 2026 is projected to remain around 1.2 billion ounces. But here's where it gets interesting. Demand is shifting. Industrial fabrication, which makes up the bulk of silver consumption, is forecast to decline by 2% to around 650 million ounces. Wait, decline? Yes. And the culprit is solar panels. Solar photovoltaic demand has been a massive growth driver for silver over the past decade. In 2016, solar panels used about 80 million ounces of silver. By 2025, that had jumped to 200 million ounces. But here's the problem. Silver prices going to $100 plus per ounce made silver account for 30% of solar panel production costs. Historically, it was only around 1.5%. That's unsustainable. Chinese solar manufacturers, who dominate global production, are now accelerating plans to substitute silver with copper or develop silverless solar panel technology altogether. This is called demand destruction. When prices get too high, industries find alternatives. So while solar installations are expected to keep growing, the amount of silver per panel is expected to shrink significantly. That's a headwind. But other industrial applications are growing. Electric vehicles use about 5 ounces of silver per vehicle due to all the electronics and wiring. With 14 to 15 million EVs expected to be produced in 2026, that's 70 to 75 million ounces of demand right there. AI data centers are another emerging demand driver. Silver is used in circuit boards, brazing alloys, and soldering because it's one of the best conductors of electricity. As data center construction accelerates globally, that's incremental demand. So industrial demand is shifting, solar down, tech and EVs up. But overall, it's declining slightly. Now let's talk about investment demand, the wild card. Physical investment, coins, bars, bullion, is forecast to rise 20% in 2026 to 227 million ounces, a 3-year high. Why? Macroeconomic uncertainty, geopolitical tensions, concerns about Federal Reserve independence, inflation hedging. Precious metals tend to attract investment during times of uncertainty, and 2025 to 2026 has delivered plenty of that. In January 2026 alone, retail investors in the U.S. poured money into silver ETFs at a record pace, faster than popular tech stocks. Global silver ETP holdings now stand at 1.31 billion ounces. But here's the catch. Investment demand is fickle. It can reverse quickly. When the Kevin Warsh Fed chair nomination was announced, the dollar strengthened and silver dropped 10 to 15% in a matter of days. Investment flows amplify volatility in both directions, so while rising investment demand is supporting prices now, it's not guaranteed to continue. So we've got a structural deficit. Supply isn't keeping up. Above-ground inventories are being drawn down. What could this mean for silver prices going forward? Let's look at what analysts are saying. JP Morgan sees silver averaging around $81 per ounce in 2026, more than double the 2025 average. Their year-end target is $85 per ounce. Bank of America forecasts an average of $56, with a potential peak of $65. The Silver Institute notes that silver has already risen 11% in 2026 as of early February, and they expect continued support from tight physical markets and investment demand. Some bullish voices, like Robert Kiyosaki, have suggested $75 could be reached. Other forecasts range as high as $106 to even $200 in more extreme scenarios. But, and this is critical, these are forecasts, not guarantees. Silver is incredibly volatile. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, dropped from 80 to 1 in November 2025 to below 50 to 1 in January 2026. That's the lowest level since 2012. It's since rebounded to around 65 to 1. What does that tell us? Silver tends to outperform gold on the upside during bull markets, but it also falls harder on the downside. A 2% drop in gold can translate to a 10 to 15% drop in silver. So while the structural deficit could support higher prices over time, the path won't be smooth. From a technical standpoint, silver has found support around $69 to $70, which is a key level to watch. Resistance appears to be around $85, which aligns with JP Morgan's target. If silver breaks above that level and holds, the next psychological barrier is $100. But if it falls below $69, we could see further downside toward the $60 range. Traders are watching these levels closely. Now let's talk about the risks and reasons why this deficit narrative might not lead to sustained higher prices. Risk number 1, demand destruction. We've already covered solar substitution. But it's worth emphasizing, if 200 million ounces of solar demand starts disappearing over the next few years, that's a massive chunk of the market. That could flip the deficit into a surplus pretty quickly. Risk number 2, recycling supply could surge. At $80 plus per ounce, there's a huge incentive for scrap supply to come online. If recycling ramps up faster than expected, say to 250 or 300 million ounces, that could ease the deficit significantly. Risk number 3, investment demand could reverse. In January, silver was driven by a surge of retail and institutional buying. But when sentiment shifts, those same investors can sell just as fast. If the Federal Reserve signals a more hawkish stance, if the dollar strengthens further, or if risk appetite returns to equities, precious metals could lose their appeal. We saw a glimpse of that in early February. Risk number 4, tariffs or lack thereof. The Section 232 report on critical minerals was released in January, and it didn't impose tariffs on silver. That was actually a relief to the market. But the report left open the possibility of future tariffs after a 180-day negotiation period with trading partners. If tariffs do get imposed, it could create short-term price spikes due to supply chain disruptions, but it could also hurt industrial demand by raising costs. It's a two-edged sword. Risk number 5, correlation with gold. Silver doesn't trade in a vacuum, it's highly correlated with gold. If gold prices come under pressure, whether from Fed policy, reduced central bank buying, or a shift in macro conditions, silver will likely follow. Gold recently hit $5,000 per ounce, but if that rally stalls or reverses, silver will feel it. So while the deficit narrative is compelling, there are legitimate reasons to be cautious about extrapolating it into guaranteed price gains. Markets are complex, multiple forces are at play. All right, let's bring this together. Here's what we know. The silver market is facing its sixth consecutive year of deficit in 2026, with demand exceeding supply by 67 million ounces. Above-ground inventories have been drawn down since 2021, and the physical market is showing signs of tightness, especially in London. Mine supply is growing slowly because 70% of silver is a byproduct of other metals, making supply inelastic to price. Industrial demand is shifting. Solar is facing substitution pressure, but EVs, AI, and data centers are picking up some slack. Investment demand surged in late 2025 and early 2026, pushing prices to an all-time high of $121 before a sharp correction. Silver is now trading around $79, with analyst targets ranging from $56 to $85 plus for the year. The structural deficit could support higher prices over time, but volatility is inherent to this market. Risks include demand destruction in solar, surging recycling supply, fickle investment flows, potential tariffs, and correlation with gold. So what's the takeaway? The silver market is at an inflection point, the deficit is real, the fundamentals are tight, but the path forward is uncertain. For investors, this is a market that requires careful monitoring, not reactive decision-making. If you're interested in silver exposure, consider the full picture, not just the bull case. Understand the volatility, understand the risks, and whatever you do, don't bet money you can't afford to lose on any single commodity. If you found this breakdown valuable, consider subscribing. We'll continue covering major developments in commodities, markets, and the global economy. Drop a comment below. What's your take on silver? Are you watching this deficit story? Or do you think the risks outweigh the opportunity? Let's have a conversation. Thanks for watching. I'll see you in the next one.